Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. With the failure of Silicon Valley Bank as well as Signature Bank over the weekend, we need to talk about the FDIC. Specifically, what do they do, how can they help us, and how does that entire thing work? First, we'll start off with the history of the FDIC, and I'll do a very brief version of it. FDIC stands for Federal Deposit Insurance Corporation. Basically, they step in and say, look, a bank failed, but you are still going to get your money, assuming that you have $250,000 and below. It used to be $100,000, but this changed due to the Great Recession. So in this video, we're going to break it down. We're going to bring out the whiteboard because I don't get to use it often. Of the 250 videos we do a year, I might only do like 3 or 4 whiteboard videos, but because you guys enjoyed it so much, I'm going to keep doing it until we don't have an excuse for it. So I'm going to go ahead and break it down. So again, the FDIC started, or was founded rather, in 1933 due to a law that was passed as a remedy to the Great Depression. Reason was, back then, there were no insurance clauses or anything that could protect you if a bank failed. If there was a bank run, which means too many people are asking for their money, 100% of their money rather, out of a bank at one time, that bank failed, nobody got their money back. That was it. So imagine if somebody said, hey, look, I'm withdrawing all my money from Bank A down the street and you don't have FDIC insurance. Oh, I'm going to be in line too, because whoever is last is a person who's not going to get their money. Today, however, and really over the last 90 some odd years, there has been an insurance clause saying that under a certain amount, you are going to get your money, and it is backed by the full faith and credit of the United States government. Those who had money at SVB, they got their money and they have access to the money as of Monday. So really, within 24, 48 hours, insurance kicked in and you are going to be fine if you are under the $250,000 limit. So in addition to breaking down how this works, I'm also going to show you how to increase your protection in case you got more than $250,000 in cash. So I'm going to show you how to break that down and give you the 3 easiest ways to do this, which have been around for forever. In fact, if you are in the financial industry, you probably know this already. We have to take the exams like I did. This is one of the questions on the exam. So I'm not teaching you to the test per se, and I was a teacher, but I am going to show you some of the little tricks and tips, all free, that you can use to increase your FDIC insurance. Okay. Now, first thing about the FDIC, remember this is for banks. Credit unions are protected under a separate measure, but it is very, very similar. But again, every bank in the U.S., you're going to see a sticker, even on the app at the very bottom, you're going to see FDIC to show you that they are insured by the federal government. So let's go ahead and break it down and show you what it looks like. Okay. FDIC insurance. All right. It is all jumbled together and y'all know what the deal is. Okay. So you are insured as of today and over the last several years up to $250,000. So if you got that, you're going to be fine. The federal government's going to step in and make sure that you get your money. Now, what happens if you have more than that? Let's say that you have $300,000. You've got $300,000, then $50,000 here, in this case, is not insured. Okay, $250,000. Plus the 50 is going to give you 300, so this would be not insured. Very easy, very simple. Anything over 250 is not insured. That bank fails, that money could be gone. So the question is, well, wait a minute, I've got more than 250. What are some ways that I can protect myself to save that additional 50 and make sure that it is also protected? Again, these are not the only ways. These are the 3 easiest ways and the 3 most free ways to do it as well. So the first way is to just move banks. Move banks. All right, that's the easiest one. For those who watch the NBA, Giannis Antetokounmpo has like 50 bank accounts. So he wants to make sure that he's super protected for the FDIC. Now, I don't recommend you having 50 different bank accounts. And the reason is, should something happen to you, it's going to be real difficult for those who are left behind to track down all 50 accounts, to send all the paperwork to make sure that they inherit what you leave behind. So 50 is a lot. Now, he's got lawyers and teams and plenty of millions of dollars. So I'm sure he has that, or at least I hope he has all that sewn up. So he might be fine. But for everybody else, having 50 bank accounts is a lot. Personally, I recommend having 5. That's just my personal number. The reasons why I like to have more than one account is because, one, FDIC insurance is a part of that, but also bank apps mess up. That happens, right? If I need to write a check from one account and I run out of checks or something like that, I can go to a different bank, assuming that I have checks there. It's a lot easier for me to operate, and it just keeps me a lot more organized. My accounts for my bank for bills, it just has all my bill money. The other one has just travel and savings. The other one is for business, right? So personally, I like 5 different accounts. You choose what works for you. But if you're looking for the easiest way, you can say, look, I've got 250, I got an extra 50 here. I'm just take that, put it in a different bank. When I was a financial advisor, I had a lot of older clients who were always asking for FDIC insurance and trying to make sure that they were protected at all times. So moving banks was one way that they did it. However, the most common was doing this. The second way to do it is what's called TOD, or actually payable on death. Now, they call it either TOD transfer or transferable on death or payable on death. It's basically adding a beneficiary. And for every beneficiary you have, you get an additional $250,000. So let's say you have yourself and 4 family members. That's $1.25 million in FDIC insurance. Every beneficiary. So that is the easiest way to do it, and usually you can either do this from your bank app in some cases. Sometimes you can log online. If you have like a Bank of America or especially Chase, I did for Bank of America a while back, it was easy, and all I did was, hey, add my wife. When my kids turn of age, I can add them, add my mom, whoever. And the good thing is it does 2 things for you. Yes, it increases your FDIC insurance, but 2, it helps with your legacy planning. Should something happen to you, it goes directly to that person, and you don't have to go through probate. You don't have to do all these crazy hoops, or the people you leave behind don't have to go through those crazy hoops. It just makes things a lot easier, and you can change beneficiaries as many times as you want, and it is free and easy to do. The other thing too is it retains control of the account to you, because the third reason here is this, or the third way here is this. You can do a joint account. A joint account, obviously you have 2 people that have access to the account at the same time. So I mentioned this in the other video on Saturday. I can increase my insurance by having an account for me at $250, an account for my wife, or we can have a joint account, and that would also have additional protection. The downside, depending on who you are and what your relationships are with whoever you have that joint account with, is the fact that they also have access to the account, right? So I can spend, they can take all the money out of the account. Again, it depends on who you with, right? So would I put my 4-year-old child on a joint account? Probably not. Would I put my wife? Yeah, we're good, right? You don't want to just put anybody on a joint account. So again, that depends on your preference and who you're putting on this joint account, but they're going to have access to it. But it does increase your FDIC insurance as well. So it's another way to do it. So your 3 ways, you can easily just move banks. Okay, that's number 1. Number 2, you can add beneficiaries to it. That's going to give you control. They don't have access to the account until you pass and it goes to them, but that also increases your FDIC insurance. And then you can go for a jointly titled account. To do that, this does require you to change the way the bank account is named. It can also help if you have like a checking account, it's going to change and say, instead of just Kevin, it's going to have Kevin and spouse. It's going to have your name plus spouse. Or it doesn't have to be a spouse. It could be you and a friend, domestic partner. It doesn't matter actually, but you can have, when you have a jointly titled, it will be different. The title will be different. It will not be the same. Also keep in mind that sometimes if someone gives you a check and it's going to go in their joint account, they may have to say, Kevin and or spouse to go into that account. It can't just be, in many cases, just your name only. So keep that in mind too with joint accounts. Married couples love this. Again, increases your FDIC insurance as well. So those are the 3 easiest ways. Now, when the FDIC does take over a bank, again, sometimes they will either take it over and sell it to another larger bank. This happened a lot in 2008. That's one way that they facilitate it. Or they just take it over outright and just manage everything and make sure people are getting their cash. Right now, at the time I'm doing this recording, the FDIC is just basically created its own bank and taken over for SBV, and we'll see what happens in the next few days or weeks. Maybe it'll get sold, maybe it won't. But again, the main thing right now, as an individual, you are fine. Okay, you don't need to go out and withdraw all your money out of the bank all at once. or at all, because again, the FDIC is here for you. Even in 2008, if a bank failed, people got their money and they got it in short order. Now, the next question you might be thinking is, what about the stock market? What does this mean for the market as a whole? The time I'm recording this, I'm kind of doing this in the middle of the day. I'm going to double check on my watch. The market is still up. So the market is up. And I think that's more so because our protections that we did put in place are currently working. What we don't want to see and what we don't want to happen is the bank fail and then companies like Roku don't have access and everything starts to fall apart, right? That was a doomsday scenario, that we currently avoided. So that is a good thing. The regulators also said that even those who had above the $250,000 mark, they are also going to be able to access their funds. So that seems to be something that is good. It's not costing taxpayers, they say, so that's also pretty good. But again, you are currently protected if you're under that amount. I just gave you 3 ways to increase that amount if you are not. The other thing, again, with the market is a lot of these bank stocks have not done well for obvious reasons, especially regional banks. I don't expect that to change. I have said for a while now, almost a year, maybe a year and a half, that I was off of bank stocks. I thought bank stocks were going to do well in like 2021, early 2022. And then by February, March, we was like, we don't think it's going to work. So I would avoid bank stocks if you're looking to get into it. What would I invest in? Number one, index funds. I did an entire video about index funds last week. That's always a perfect go-to if you ask me, okay? Outside of that, healthcare is probably still a good spot. We have seen other financial companies kind of waver. I was very big into insurance stocks. Principal Financial, because they got the name financial, they're not doing well right now. That's the break. Is it fair? No. They're an insurance company, but they have absolutely tanked. They're down almost 17% as of this morning over the last 3 months. Can't help that. That's the beauty of index funds, because you got that and what, 500-600 other stocks all kind of into one investment. My other insurance stocks that I've talked about before, Progressive, still fine, and others are still on the up and up, but you definitely want to be a lot more careful. This is definitely one of those index funds type of moments, okay? Which is why we talk about them so much, and why I say rather that should be like the core of your investment portfolio. If you're looking to invest in something, there are plenty of other videos that we do talk about on the channel that still make sense to invest in, but whatever you do, there are a lot of people that say buy low, sell high. This is not one of those moments where you want to buy low into a company that could be failing and is already failing. There are some banks already that are down 60-70%. This is not the opportunity, in my view, to buy something that's clearly not doing well. There's a thing called momentum where over the last 6 to 12 months, if that has occurred with a stock, it is likely to continue. Not a guarantee, but it is likely to continue. So I would just be very careful. Be very careful about what you're investing in. The key thing, both on the banking side and the investing side, is to remain calm. This is a long-term thing. Whether or not we're going into the next Great Recession or any recession at all, we still do not have confirmation of that. Remember, we survived 2008. The market is up, I think 3 or 4 fold since then. The market is still up from 2020. I had someone DM me say, hey, what do I do when the market just ups and vanishes and things don't go well and the market hasn't recovered from 2020? It actually has. The market is still up from the pandemic in 2020, which was the last time we had an official recession. This is one of those times to exercise patience. This is one of those times, again, to exercise patience. I said this exact same thing in the middle of 2020 when everything was on fire. You are going to be okay, but you do have to be patient and you do have to be smart. Okay, that is it for me. The garage door is opening in the middle of a video. It happens. But if you want to learn more about investing, what to look for, how to understand everything that's going on, this is the place to like and subscribe. But if you want an advanced version and you want to know all the ins and outs, you want to make sure you join our members only. All right, that is it for me. I'll talk to you tomorrow. Bye.